We just got some shocking news about the economy, and as you're about to see, things are worse than even I thought. Now, let's turn to Bloomberg, where we picked today's story up with a headline is even top earners are falling behind on credit card and car payments. And this shouldn't be happening because if you look at the stock market, it's sitting near all-time highs, telling us that the economy is about to boom. The tax bill got passed. The trade war is almost over. And at this point, the economy is telling us all we need is a couple Fed rate cuts and everything's set to boom. But the problem now is we're not just seeing people at the lower income levels fall into delinquency. When you start to see high income people fall into delinquency, well, it means things are going the wrong direction and fast. As U.S. delinquencies jump for upper income borrowers, as those making at least $150,000 annually are now see their past due debts rise at the fastest rate in years. And again, this is a major problem because when people go into delinquency, well, their spending naturally goes down. And again, we've been seeing this for years at the lower income levels, but one thing that we've been hearing is the economy's been booming on the strength of the wealthy, and they're the ones that are supposed to benefit from the tax cut and the economy, and they're going to spend in a big way. But we're finding out that right now the economy isn't working for anyone. Delinquencies on such debts from those making at least $150,000 annually have jumped almost 20% over the last 2 years, faster than for middle and lower income borrowers. And what this is telling us is that something is wrong with the economy. Because again, you look at the stock market, it's sitting at all-time highs. Crypto is up. So the wealthy should be wealthier. They should be spending money and have absolutely no problem paying on their debt. So what this is telling us is there's something structural wrong with the U.S. economy. What it means is things are actually worse than I thought. A recent Federal Reserve Bank of St. Louis study found that the share of people making late credit card payments in the highest income zip codes have risen twice as much over the last year as the lowest income ones. So what is going wrong with the economy? Well, the issue is we saw a lot of hiring post-pandemic, and what we're finding out is a lot of those high income jobs are starting to go away. We're seeing businesses start to struggle. Remember, we've talked about how a lot of small businesses have been struggling at the margin for over 3 years. And now we're starting to see the effects of it, as what we're finding out is there is not just a recession on the horizon. What you're seeing is the effects of a currency shortage, because in a debt-based economy, when delinquency rises, well, it means there isn't enough money to go around. The mounting liabilities coincide with a slowdown in hiring that hit white-collar workers especially hard. Well, the issue for white-collar workers is, again, they had all of this big boom in hiring post-pandemic. Companies have been laying off, particularly a lot of tech companies who have been spending billions on AI. And the problem is they need to cut workers because they're not seeing a return on investment. Now, what are we hearing in a lot of the surveys? That those who do have jobs are worried if they lose it, they can't find another one. It's not about hiring. It's about the fact that the economy isn't creating jobs here. And this is raising the stakes for an economy that's come to rely more on consumer spending from top earners to power the continued expansion. And again, in our economy, consumption is about 70%. But overall, the issue is it's coming from the upper echelons. And now what we're finding out is they're running out of money. And when that happens, their spending plummets, and right along with the economy. Now, if you're looking to turn your finances around, we have made some major updates to our trading program, easing out of last night. Now, you may have heard that we have been building a meta strategy that takes into account the Bravo 9, a 200-day moving cross, a golden cross strategy, RSI divergence, a 520 EMA cross, turtle trading, and channel trading to create an optimal swing trading program that gives you trades for a hold period of 2 to 15 days, over 130 signals per year with a success rate of 53%. And that blows away about anything you could find. But last night, I did something really cool. I started work on an optimization program to optimize all of the parameters for these so we can build a super swing trading strategy. And here's the best part. You can get in on these trades from our new program right now for free. That's right. Grab the links in the description below. Sign up for any one of my programs. Use the coupon code for a free 30-day trial, and you too can start getting those meta trades and find out why we're on the cusp of a major breakthrough in changing how you trade and make money in the markets. Because financial stress is evident from the lowest income households to the highest income households. With the Federal Reserve keeping interest rates high and pandemic era student loan forbearance programs now over, it's just become very difficult to juggle all of that. Now, we've been talking about how this student loan forbearance program was going to be a major hit to the economy because it meant people that haven't been paying or haven't been paying as much as they normally would were going to start have to pay on that debt. And that was going to naturally affect the discretionary side of the economy. The problem on top of this is we're finding out the economy isn't working for the upper echelons. They're going into delinquency, meaning their spending is going to drop in a major way. And the evidence is clear. Let's take a look at this next chart. Because when we look at real retail sales, that's inflation adjusted, shown in blue on a year-over-year rate of change, and overlay the delinquency rate on credit card loans in red, let's go back to the dot-com bubble and we can see exactly what happens here. As the delinquency rate rises, what happens? Real retail sales fall. And this makes perfect sense because if people are in delinquency, well, they can't use their credit cards because their limits get dropped down, and they certainly aren't going to go out and be able to get new loans to buy stuff. Remember, the U.S. economy is powered completely by people buying things they don't need with money they don't have. And when that dries up, you've got a massive problem because there's a major inventory overhang right now on top of things. Let's move forward to the global financial crisis. What do we find out? Delinquency rate heads up, real retail sales go down. And now let's fast forward to where we're at. Late 2021, we see the delinquency rate rising. What happens? Right at the same time, real retail sales come plunging down. Now we're set to see the delinquency rate head higher. That means the probability that retail sales are going to continue to the downside. That is now the base case scenario. And this is a problem for the economy because, again, you think about all of the front running of the tariffs. There's all this inventory that's been building up. It needs to get moved, and at a time, we're going to see financial stress, not just at the lower and mid incomes as they look to have to start repaying student loans, but we're seeing high income earners. We've seen their delinquency rate jump over the last 2 years, outpacing everybody, telling us it's an economy that's working for nobody. But with hiring continue to slow and pay raises becoming more of a rarity, the share of workers getting zero increases in June rose to an almost 4-year high, according to the Atlanta Fed. Debt woes will keep the outlook for spending in a precarious position. And there's little doubt that that's true because we've been mentioning in the last non-farm payroll report that on top of that, hours worked slumped to the second lowest level since the pandemic. So not only are pay raises going down or even flatlining to zero, we're seeing the number of hours drop. Now, on Friday, we'll get an update on the non-farm payroll report. If that hours work number drops even more, watch out. It's a surefire sign we're heading into a recession. And it's also evident that the economy isn't working for anybody as we continue to see everybody across the income spectrum slide into delinquency. Now, remember, for the banking system right now, as bank stocks trade near all-time highs, everybody thinks there's going to be a big boom. But remember, if everybody falls into delinquency and goes into default, well, the banks aren't going to be winners in that scenario. Let's take a look at this next slide because it's not just about pay raises, it's all about hours. Here you can see the clear evidence. Now at the second lowest level of average weekly hours of production of non-supervisory employees since the pandemic. And you can see the very clear relationship between hours worked and retail sales. As paychecks shrink, what happens? People cut their spending. Now we're finding out across the income spectrum is that everybody is falling behind. And again, this is a dangerous sign because what it means is consumers are going to start deleveraging, and that would only bring the debt to GDP ratios back to levels that prevailed at the end of the 1990s. But the issue here is that consumers cut back. We have a major problem with the economy because, again, the stock market is telling us it's poised to boom, it's poised to head higher. But if consumers are falling behind and we're running out of money, well, it tells us that growth is going to head down, which is validating why we're also seeing inflation go down as well. Let's take a look at real retail sales against real gross domestic product. Now that's shown in red on a year-over-year rate of change. And you can see the clear relationship between the two. So if we know that wage growth is slowing and hours worked are dropping and the consumers are falling behind and in delinquency and are not going to be able to spend as much money, it means retail sales are coming down. It means growth is coming down. And what it means is Fed rate cuts at this point won't make a difference difference, although we're likely to see them before the end of the year, because what this also tells us, inflation is going to drop. No matter what happens with the tariffs, if consumers don't go out and spend, well, you can increase prices. But if nobody buys them, it means they're coming down and in a big way. And what all this is signs of is there's stress in the labor market. We got more validation about that today as U.S. job openings now fall to 7.44 million after back-to-back jumps. Now remember, we've been talking about the relationship between the JOLTS survey and the stock market, and I've been warning that if the JOLTS survey is right here and it continues to trend down, that this upward movement in stocks over the past couple years is going to have to reverse. But all of a sudden, the JOLTS survey turned up. Everyone was starting to say, no, the economy is going to follow the market. Well, now things are changing and in the wrong direction. Tuesday's report supports characterizations of a cooling labor market, but only gradually, and job openings remain above average levels seen prior to the pandemic, suggesting there's still relatively healthy demand for workers. But the issue is that's changing and fast. However, hiring has slowed and is taking unemployed people longer to secure a new position. In fact, it doesn't appear that hiring has slowed. It appears it's grinding to a halt, because what are we seeing in the continued claims data is it continued to tick higher a little bit each and every week, suggesting that as people lose their job, and keep in mind, initial claims remain at actual historical low levels, that those on unemployment are in a precarious situation. They're not able to find work, and now they're finding themselves in delinquency. The problem is, this whole thing is about to snowball. But let's take a look at why this labor market cooling period is going to get ice cold. As we take a look at the JOLTS survey in blue against average earnings of production and non-supervisory employees, that's shown in red on a year-over-year rate of change. And what are we hearing from employers? That this is going down. They're not giving out the raises because they're not moving inventory. What they're finding out is they're getting squeezed at the margin. And that means at this point, they've cut all the expenses they can. It means they're going to have to cut hours. They're going to have to cut back on pay raises, and they're going to be forced to cut jobs. And based on the relationship between those two data points, what it tells us is the JOLTS survey is going to get even worse in the future. And while layoffs were a little changed at this subdued level, fewer workers voluntarily quit their jobs. And why is that? Because what are we hearing in the surveys? That people know that if they lose their job, they can't get another one. So now they're not quitting because they already know there is nothing better out there. Again, that's a major problem. It tells you the economy is slowing down. And what it suggests is people are less confident in their ability to find a new position than they were last year. It's not lack of confidence in their skills or ability, it's a lack of confidence in the economy. And again, the evidence is mounting as you see more and more people fall into delinquency. It's telling you this economy is going the wrong direction. It's slow at first, and then all of a sudden it'll hit and everything will come unwound. And one of those things is likely to go with it is the stock market. And right now it's telling everybody the economy is booming as it heads higher. The problem is if you look at the long-term relationship between the JOLTS survey and the NASDAQ 100, that's shown in red, because what this tells us is either the number of job openings needs to jump higher and validate that the economy isn't booming as the stock market says, or the stock market needs to come crashing down. And all this begs the question is, why are consumers more optimistic when they're falling behind? Well, let's take a look at what the media says, and I'll tell you what the real reason. Because consumer confidence rises on outlook for the economy and the job market, but that can't be the case because the JOLTS survey just said that people aren't quitting their job because they're worried they can't get another one. And as far as the economy goes, well, the only thing right now that's trending higher, well, that's the stock market. And the conference board gauge of confidence rose 2 points to 97.2. A measure of expectations over the next 6 months climbed in July to 74.4, the highest since February. So what this is telling us is that consumers are looking out in the future and they're feeling that things can only get better. Or maybe they're just hoping things are going to get better. Because the gauge of present conditions, well, it fell to 131.5, suggesting that consumers right now, today in the economy, are losing confidence. Their only hope is that things get better. Because if they don't get better, you know what comes next? Well, it means the unemployment rate's about to surge higher. Because when we take a look at the JOLTS survey against the consumer sentiment survey, we're using the University of Michigan because the FRED database doesn't have the conference board data. And we've been wondering, is this big drop in confidence, does it have anything to do with the labor market? Well, you can see the relationship over time that when the JOLTS survey drops, it means confidence goes with it. And And what consumers are telling us right now is that job openings are about to plunge. And what happens when job openings plunge? Well, we know pay raises go away. And after that, well, the layoffs start to begin. And the share of jobs that were hard to get increased to a 4-year high of 18.9%. The share saying jobs were plentiful also rose, but to a lesser extent. The difference between these two, a metric closely followed by economists to gauge the job market, was the smallest since March of 2021. Everything is telling us very clearly that the economy is slowing down. Things are getting worse. And again, this is a major red flag here, particularly as we're going to hear from the Fed tomorrow. They're going to tell us the labor market is strong and holding up. The non-farm payroll report on Friday probably going to give us some sort of validation on that. But in the months to come, watch out, because if these delinquency rates continue to rise, it's game over for the U.S. economy. And the evidence is clear as we turn to real retail sales, shown in blue, against the JOLTS survey in red. As job openings go down, sales go down, and you can see everything starts to unwind, and that's the risk we're facing right now. You can see both of them dropped in 2022. Right now, what are we seeing based on the trends in the JOLTS survey? It's likely to go down as consumers worry more and more about their jobs, their spending goes down, their savings go up, and next thing you know, the entire economy starts to fall apart. So when we go back to where we started with the sentiment survey, why is it up? Well, it's likely up because the stock market's up, but is it going to stay that way? Well, probably not. Let's overlay the delinquency rate in credit cards against the University of Michigan Consumer Sentiment Survey. And what do we see? There's clear evidence. As the delinquency rate goes up, confidence goes down. And you can see that in every cycle, suggesting right now that the delinquency rate in the data we're seeing right now is going to surge higher, meaning more Americans are going to fall behind on their credit cards and their card payments. And we know what happens as people go behind and then they enter default. Well, that was something we last called the global financial crisis. We could be on the cusp of a repeat. The problem is this time we're also going to see commercial real estate come unwound as well. The red flags are rising fast, and based on what we're seeing, things right now are far worse than I thought. And again, if you want to get in on our new swing trade report, you can jump on either subscription. That's right, grab the links in the description below. Use a coupon code for your free 30-day trial, because as we get to this optimization data and get it all tied together, we're going to create an optimized meta trading strategy. It's going to blow away anything else on the market, and right now you can preview it for free. Again, grab those links in the description below. Use your coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.